有请主持人国泰君安证券股份有限公司首席经济学家何海峰老师。
尊敬的
Ladies and gentlemen, good afternoon. Whenever it comes to the release of reports, I'm very excited.
这个环节的效率，欢迎大家参加布雷顿森林体系过去80年与未来展望国际会议暨2024。
So, welcome to the 80 years after Bretton Woods.
趋势展望，本场论坛采取线上和线下相结合的形式。基于时间的考虑，我不再一一介绍各位嘉宾。需要向大家说明的是，这4位嘉宾，包括我们发布的嘉宾，都是吴晓灵行长专门邀请圈定的。大家也能看得到，是国内最重磅的一线的专家。中国金融政策报告这个项目最早缘起是在上海，目前是由清华五道口金融学院和中国社科院金融政策中心联合设立。吴晓灵行长以及陆磊副行长是联合总负责人，丁志杰主任和我是执行负责人。这个报告到今年为止已经15年了，其实16年、17年来一直得到涂市长和各位专家的大力支持这里我们首先进行第1项报告的发布报告的发布有请国家外汇管理局研究中心主任丁志杰教授，丁校长有请。
尊敬的李安院长、涂光绍理事长、黄一平院长、张晓慧行长助理，还有陈董事长，各位嘉宾，大家下午好，我是国家外汇管理局外汇研究中心丁志杰，受吴晓灵行长和陆磊副行长的委托呢，今天代为发布2024中国金融政策报告。因为大家知道，今天这个环节这个重量级嘉宾云集。刚才我们在休息，在会议室3地，我把我的这个发布时间呢，有20分钟压缩到10分钟左右，好吧？大家知道，去年10月份召开的中央金融工作会议，以及总书记在这次会议以及今年年初省部级主要领导干部金融专题研讨班的这个讲话，为未来一段时间的中国的金融发展和金融工作指明了方向。那么，正是基于这些呢，我们2024中国金融政策报告呢，选择以加快建设金融强国、推动金融高质量发展为主题，然后进行了这次报告的这个主报告各位的主线。那么在这个主报告中我们强调了这个加快建设金融强国的重大意义，总结中国特色金融发展取得的阶段性成果成绩，并对中国特色现代金融体系和中国特色金融发展之路进行分析。那么这是整个。
This is the framework of our master report. This report has been published, so for any details, please read the report. First, we need to understand how China will become a financial powerhouse, the path and the key factors and systems and dimensions. So how can China become a financial powerhouse? It's not just that China will improve its financial strength, but also improve the allocation of resources and to serve the real economy. So it's not just about quantity, but also about quality. And there's also an international dimension. We need to benchmark against other countries, and we need to be expand our businesses internationally and improve corporate governance. And the second part is a review of China's accomplishments, especially in 2023, how China has improved both in terms of quantity and quality of growth.
来进行一个简单的梳理。第一点呢，就是人民币国际地位不断提升。我们知道，总是讲到金融强国的6大要素，第一个要素就是强大的货币。那么强大的货币，我们想呢，一定是一个国际范围的一个横向的一个比较。那么我们也看到，在过去人民币国际地位不断提升。那么目前呢，外国投资者持有的境内的人民币资产在10万亿元人民币左右。第二呢，我们也会看到人民币在全球的跨境结算，在各国的外汇储备的占比也在上升。但是我觉得有2个因素值得我们关注。一个因素呢，体现说，在除了有中国经济主体参与的活动之外，已经有没有在人民币作为第三方货币开始被使用，特别是在俄乌冲突中，比如说俄罗斯与印度的一些石油的贸易，其中一些使用的是人民币。那么这也代表人民币国际地位的一个明显的一个上升。第二个层面呢，就是说人民币作为一种融资货币开始发挥积极的作用就是说作为一个国际货币或者一个国际金融中心，它不仅仅为外国提供一个投资的功能，它还提供一个融资的功能。那么这点呢，其实也在开始逐渐的显现出来。那么具体的这个数据大家可以看我的 PPT， 或者呢更详细的见我们的这个报告的我们报告这本书那么我们也看到，比如说从近期来看，今年前4个月由于美元美联储这个降息的步伐放缓，美元走强，亚洲货币呢呈现了比较大的压力。但是我们会看到人民币呢尽管有一定的贬值压力，但是在亚洲货币里面还是显现了一个较强的一个韧性特别是我们看到，在我们5一假期之前，4月30号，中央政治局决定召开3中全会，应该说使得整个全球的投资者对中国的资产以及对人民币汇率的信心都显著的增强。这是我们第一个层面，大家看。第二个呢，就是说现在中央银行建设呢取得积极的成效。那么在去年我们进行了逆周期调节，包括2次下调存款准备金，2次下调政策利率，包括带动这个贷款这个市场的报价利率、市场利率的这个下行。那么在今年初，那我们进一步降低了这个存款准备金率。那从金融稳定的这个层面来看呢，我们看到从供需两端综合施策，促进房地产的平稳运行。那我们特别看到就是在这个月设立了3000亿保障性这个住房再贷款，支持地方国有企业以合理的价格收购已建成未出售的这个商品房，包括有序推进这个金融支持这个融资平台债务风险的化解工作。那么第3个层面是金融改革开放，就是说作为一个中国的这个金融开放的一个重要的部分，就是说债券中的债券已经纳入到香港金管局的人民币流动资金安排叫合格抵押担保品这个名录，也就是说可以作为人民币的这个债券持有者可以以自己所持有的这些资产作为获得融资的一个担保品。 那么还有呢，就我们进一步优化了这个支付服务，特别是提高了就是说跨境外国人来华的这个支付的这种便利化。我们也进一步扩大了柜台债券的投资品种，优化相关的机制安排，以使得我们的比如债券，特别是国债，能够进入寻常百姓的这个资产组合的范围之内。第三个层面，我们看到呢，就是金融机构的规模，金融机构不断的发展的壮大。那我们知道，在全球29家系统重要性银行里面，中国有5家银行入选，而且这5家银行的得分是逐年的上升，这也和我们的中资银行的快速发展以及全球竞争力的稳步提升这个趋势是相吻合的。那么金融呢，服务实体经济的这个能力进一步提升。我们知道，那么我们对中国特色金融发展之路第3个特征呢，就是说金融服务实体经济，需要政治性和人民排在第3位。所以说金融这也体现了我们讲的金融强国强就体现服务实体经济的效能。那我们这里面列举的人民币的贷款的这个变化，以及普惠金融，以及支持制造业，特别是高技术以及现代这个制造业，那么的贷款都显著的高于贷款的平均的这个增速。第4个呢，就是说中国的国际金融中心的地位逐渐提升。那我们也看到，就是说中国如果从目前来看，中国有包括香港、上海、北京、深圳在内的这个4个城市稳居在全球前20大金融中心之列。那么这个来看呢，数量上呢，我们可能和美国，比如说美国有纽约有华盛顿，有旧金山，那么有时候有芝加哥，其实基本上是数量上也是一致，而且总体来看，就是说显现了就中国的金融对全球的这种影响力。第5呢，就是说现代金融监管体系不断完善。我们也知道，我们构建了包括宏观审慎管理、微观审慎这个监管，保护消费者权益，然后打击金融犯罪，维护市场稳定，处置问题机构的一个金融监管体系框架，包括我们进行了这个监管这个体制机制，特别是机构的这种改革。那么这些都是在去年发生的重要的事件。第6个呢，就是金融人才的队伍素质不断的提高。尽管在去年这个金融系统今年机构改革，金融领域的
The institutional reforms of last year include many aspects. And most importantly, we have to make sure that people abide by the top-notch standards of operation and the workflow is not interrupted at all. That is why in 2023, we're seeing heightened political awareness and better workflow, smooth operation of the financial talent pool without any corruptions. That is a quick review of what happened last year. Last but not least, in the 3rd dimension, I would like to talk about the development of a financial system with Chinese characteristics. It comes in 3 parts. And we have also laid out the prospect for the future. So we further deepened the financial reforms for innovative development, leveraging macro control and regulation to establish an enabling environment for monetary policies.
Including the micro-prudential and monetary policies. And secondly is to balance the interior and exterior, the interest rate and exchange rate and their relations, so that the Chinese economy could achieve stable progress. And meanwhile, we could tackle the uncertainties from both inside and outside. In terms of exchange rate, our exchange rate policy, first of all, need to digest the supply and demand pressure from by using the market orientation approach. And secondly is to improve the negative spiral of the currency exchange, foreign exchange. And these are the 5 major chapters from the China's Central Financial Work Conference.
These 5 chapters focus on the 5 major areas: green finance, technology finance, inclusive finance, and pension finance, which focus on the weakness. And we are also trying to promote the opening up by open the institutional arrangement. In the 20th CPC report, it was proposed that we need to stably expand rules, regulation, management, and standard, and also the related systems and institutions. In terms of rules and regulations, we need to promote these regulations to be more open and to be complying with the international standard and improve the modern financial supervision. In terms of management, we need to promote the management system and the capacity and modernize the capacity in order to open and improve the business environment. And number 4 is to further expand the domestic dimensions in order to better allocate resources so that they could serve for the economy. And secondly, we need to further improve the opening up of our institution arrangement in order to promote the level of openness of our finance system. So first of all, we need to further deepen the financial market opening up and improve the overseas investments participation into the Chinese market, bond market. And secondly, to promote the interconnectivity between the domestic and international financial institutions and infrastructures. And number 3 is to promote the multilateral development organizations' governance. And number 4 is to further open the foreign currency opening up. And in order to promote and explore the China's progressive capital market, capital account opening up. And number 3 is to safeguard the bottom line of the financial security. The more opening up, we need to be more cautious about the safety network. According to current status in the financial and economic area, there are major risks still existing, especially the real estate property and LGB risk, as well as the local small and medium-sized financial institutions, etc. And from this picture, you can see these are the what happened in the recent Chinese government endeavors. From the right-hand chart, you can see these are the different financial institutions' interest, net profit growth. These are the 3 different types of banks. The first one is large commercial banks. Second one is shareholding bank, commercial banks. And number 3 are the local banks. Number 3 is to keep the bottom security, the bottom line of the financial security, especially against the opening up environment. And in terms of the foreign exchange market, macro, prudential, plus micro supervision should be integrated. And secondly, the foreign exchange supervision and the management should be improved, especially from the Central Financial Work Conference meeting. We can see that the foreign currency supervision has been put into the agenda so that we should crack down on the underground money house and especially the illegal activities of the cross-border bribery and other illegal activities. I'm from SAFE, so that's why I focus more on the foreign currency issues. Thank you very much. Thank you, Professor Ding, which surprised the speech time in a short time period. And 15 years ago, as you can see, we have the next speaker, Mr. Mr. Tu Guangshao, the Executive Director of Shanghai Advanced Institute of Finance, to deliver a speech. You only have 15 minutes. Thank you very much. I only can present 6 minutes according to my timeline. It's my pleasure to be here today. Very meaningful. So I will skip I'll go directly to the core part of my presentation. I have I think we could summarize the report into 4 characteristics. The first one is comprehensive. Second one is very innovative, very new. Indeed, the overall financial development activities are included in this report. And with a new and comprehensive, that is not enough, because most importantly, there should be depths. That is why the third character is depths. Yes, indeed, the report is full of depths in many different regards. I didn't go through the sentences and words of the report, but I just went through them. I think the level of content is very deep, and even though I'm working as an advisor for this report, I didn't involve too much, but I deeply concerned about the report and the overall process of drafting. Number 4 is consolidate, or down to earth, because the report is serving the financial services so that they could serve better the real economy. That is why I think it is very down to earth. Now I would like to share with you my understanding of the making China a powerhouse for finance. I'll just use 3 sentences to describe. Firstly, financial powerhouse. Focus on becoming stronger in financial system. And from the financial powerhouse 866-558 insists on the targets and purposes and principles and routes, and 6 core concepts or factors, including a stronger international financial center, including Shanghai. And this is the basic structure of it. The second 6 is 6 major systems, which is the major mandate of the financial powerhouse. There are 5 fives. The first one is 5 major essays or chapters in President Xi's speech, and the 6 core factors. Another 5 is financial culture, which is the soft power. In the past, we focused more on the hard power, but now we need to focus on the soft power as well. These are the 86655. But apart from understanding and studying the series of introductions of the financial powerhouse initiated by President Xi Jinping, I think for being a powerhouse of finance, we focus on powerful, strengthen, because the strengthen will make you go from small to bigger. And first of all, you have to be strong, and then you can grow bigger. There is a connection between strong and bigger as well. But bigger doesn't mean that you're strong. Strong, for sure, will make you big. But big does not mean that you're strong. Sometimes you're big, but you're not very solid. You have a very weak foundation, and you might have a lot of diseases as well. That is why I think as a financial powerhouse, there are 3 dimensions we need to focus on. The first one is in order to be a financial powerhouse, we need to get rid of the old route. Not only focus on quantity, but also on quality, as well as functions. So we should get rid of the previous old quantity-driven approach and change into a quality-based approach, and which is a way that we have to take in order to achieve a new quality development. And China as you know, the financial asset for the financial institutions ranked very high among the world's. And different forms of financial transactions happened a lot in China, in Shanghai, and globally. And if you look at the total amount of M2, which exceeded 30 billion, which is a large number. But large doesn't mean that you're strong. In some of the areas, we're still very weak. I'll give you another example, a very simple example. It doesn't mean that our capital market didn't develop well. It develops well, but there are issues. We have 500,000 listed companies, and U.S. has around 5,000 to 6,000 of listed companies after 200 years of development. But what about the quality? Same numbers, same quantity, but what about the quality? What about their features and functions? So quantity doesn't rule. We need to focus on quality development as well, and functions of these listed companies. That is why I said quantity and quality. There should be a shift from quantity to quality. In the past, our old paths, not only in the financial area, but also in other areas, is to focus on quantity. And sometimes we're weak and big. So the second strong means we need to not only focus on the financial system, but also the non-financial system. In the past, we were competing within our financial system, but now we need to focus on not only for the financial purposes, but also for serving the real economies. So finance not only should be focusing on the financial system itself, but also those non-financial systems, because otherwise the relations between economy and finance were not correct. And
the third thing we have to adapt and change is that we have to take a look at both what's happening in China and also abroad. To be a financial powerhouse, we have to be strong in the context of the world. Globally, we have to be a strong financial power. Domestically, no matter how strong you are, if you do not hold any cloud over the world, it doesn't matter. So to be a strong financial power, we have to work hard on our own. At the same time, we have to get the recognition from the rest of the world. So how do you gauge your global influence? We still have a long way to go on that front. So if you look at financial institutions in China, we have a lot of mega financial institutions, banks with the largest market cap, systemically important banks, but how much sway do we really hold? Like, we have huge transaction volume. I work at the Shanghai International Transaction Center. Shanghai is called an international financial center, but it's not really a bona fide international center because it has a very limited amount of international business that is truly international. So we have some foreign investors participating in the equity market and bond market, but the percentage is very low, and also the global allocation of your fund is very limited as well because there is no public entities for that purpose. So you might be big, but you are not truly international. Now, RMB is our sovereign currency. RMB is becoming more and more international. However, the degree is still quite limited. RMB plays a very essential role in China, but globally, it's not that strong or even a little bit weak. So the institutional opening up also plays a role here. RMB has to play a bigger role in the financial governance, in the global financial governance process. So to be a financial powerhouse, China has a lot of work to do. We have to figure out which path to take. We have to figure out how we can really emerge as a powerhouse instead of just being fat but not muscular. So we have to truly hold strength in our financial capabilities to hold that sway in the world. And that requires efforts from across the board. So I have very limited time, interest of time. That is all I want to share with you. And I welcome your feedbacks, Mr. Wang and Chairman Yang. Oh, you are here right on time, so I'll hand it over right to you. Thank you so much, Mr. Tu, Director Tu. you made a very good summary of the report. You said it's comprehensive, it's substantive, and it's very insightful. So you also commented that for China to become a financial powerhouse, it requires both domestic strength and also international recognition. Indeed. Next, I would like to give the floor to another very important speaker. He works at international investment banks and academia and also Chinese think tanks. He served as the Monetary Committee Director twice, and he is Mr. Huang from the National School of Development at Peking University. Mr. Huang Yiping. Thank you so much for the invitation. It's definitely a very high-level forum. I'm very honored to be here to participating in the discussion and make my remarks here. It's been many years. And to my understanding, the policy report released by Mr. Ding, the report has been circulated for many years, been published year after year, and it's the first time that the content of making China a financial power is included in the report. I think Director Tu made a very good summary or comment of the report just published. After reading the report myself, I think one of the highlights of the report is that it clarifies the meaning and significance of developing China into a financial powerhouse. It also made clear some of the milestones and achievements we have accomplished. In the report, we can also see the directions we must pursue for developing that financial powerhouse. And also in that report, some new ideas were proposed. So I think it's indeed a very valuable, insightful report, worth noting, worth reading. Now, if I am here able to offer my 2 cents to the report, I think the report is very summary, meaning that it's not that long in length. Maybe if you have the resources and time, I would like to see more detailed content for the report. For example, more specific policy recommendations. You have proposed a lot of very good ideas, but I think more substance, more detailed content will be very much valuable. Speaking of building a financial power, Mr. Tu said there were some 6s and 5s. I have my own set of theories. In my understanding, a true financial powerhouse has 3 qualities: efficiency, stability, and international influence. So a financial powerhouse has to operate at a stable pace while delivering strong financial international power. At the same time, efficiency is also required. So that's what I submitted as talking points for my remarks today. How to leverage finance to improve your international influence. Now, Mr. Tu spoke before me and he talked about building an international financial center. But I wanted to originally I wanted to follow up with his talks regarding international financial center, but he actually didn't finish the whole talk about international financial center development. So I think international influence is indeed quite important for developing China into a financial power. And when it comes to your international influence, there are some challenges. Well, there are several things we can take into account. Now, a financial development path with Chinese characteristics, how can we get better aligned with the international system? We can have our own unique characteristics, but at the same time, you will want your own system to be well received by the rest of the world. And second challenge is that RMB has not been fully internationalized. There are some restrictions on the currency. How can we truly give full play to RMB as an international currency? And third challenge would be about the international. We actually have a very successful international financial center, which is Hong Kong. But how can Hong Kong play a sustainable role in the Chinese domestic financial system? How can we make sure Hong Kong is able to hold its own as an international financial powerhouse? What I mean by that is that there are many challenges in front of us in this pursuit. Of course, it's not something we can finish overnight, and we are not rushing anything, but that is something we have to accomplish. We believe that addressing those challenges will be part and parcel of making China a great financial power. Now, what do we have in the agenda for the short run? looking at the suggestions proposed by Mr. Ding, I said like maybe it would be great if the report can be a little bit more substantive in policy recommendations. So I'm just, sharing my 2 cents here. International influence of finance. Is it possible maybe China can set up what I would describe as a Global South Green Development Initiative? Specifically, this initiative will be about leveraging commercial and political tools or even assistance to support developing countries as they pursue green new energy transformations. That is a quick summary of this proposal I just made. Now, I got the inspiration because there is a hot topic recently, overcapacity. Overcapacity, my understanding of that is that back in February, some U.S. officials started mentioning the issue of overcapacity in April at the Peking University National School of Development, as we received Secretary Yellen, and during the talk, she talked about the impact of China's overcapacity on the U.S. So from the objective perspective, the 3 new things from China did not really pose much threat or impact to the U.S. For example, the U.S. is concerned about their unemployment rate and the EV industry taking a hit. But in total last year, export to U.S. was just 10K units. So that's really not that big of a number. It's not really that impactful on the U.S. economy. But I'm sure there are also a political factor at play, elections as well. But why does China have the issue of overcapacity? Incidentally, I think there is also some debate about what's the definition of overcapacity. Like, maybe for the world, there is not really overcapacity. It's overcapacity in China, but as long as we can sell to the rest of the world, there is no excessive capacity. There is no excess. But here, domestically, we do see some imbalances of the macroeconomy. We have a lot of investment, but not enough consumption. So looking at the past 4 decades, at every stage of development, overcapacity has been a consistent theme. But over the last several decades, we were able to export overcapacity. Of course, there were some domestic measures as well. That's why there is no systemic risk deriving from overcapacity. But right now, for certain sectors, we believe this issue of excessive capacity will be here to stay. It's not something that we can get rid of over the short run. Now, if we're not able to address it, the best way to get rid of it is to export it. But in the short term, as the US and European markets face challenges, there are some difficulties in that. Now, if you look at developing countries, China holds great potential. I have met with representatives from developing countries who tell me that China makes great products. They face the challenge of delivering low-carbon green development. They need to transform their countries, but they lack technologies, they lack funding, they don't have the solid products, and they believe the products made in China are essential to what they need in their countries. So as we face difficulties exporting those products to US and Europe, why don't we just export it to developing countries? Because developing countries face their own unique challenges. For example, a shortage of funding. They need your products, but they don't have the money to buy it. So I'm thinking maybe the United Nations once made an estimate. They believe that for green low-carbon development transformation, developing countries has a shortage of 1.75 trillion. So there's a great shortage, meaning that there's demand all over the world. Post-Second World War, U.S. launched the Marshall Plan. I'm sure you have heard of it. The Marshall Plan, the gist of it, or the target of it, is to use U.S. resources to support the economic revitalization of European economies, because after the Second World War, the European economies were miserable. So U.S., Europe worked together to rebuild economic vitality in Europe. It was a very successful initiative. So the Marshall Plan delivered on several goals. The first goal is to help revitalize the European economies. Second, it helped the U.S. expand its global influence, including the influence of the US dollar. And the third dimension is not able to be validated, but it's very important, is that as the European economies grew stronger, it kind of weakened the economy of Soviet Union. It limited the development of Soviet Union, which is in the interest of the United States. So it's kind of a very imaginative idea, but maybe that is one of the potential pathways. As we face difficulties in internationalization, we also see great opportunities in some countries that require joint efforts from China to help them deliver on low-carbon green development. We have the technology, we have the products, but as to whether we have the funding, people might have different views on that. But this proposal I just made, I think to some degree you can see this as a kind of green economic era. It's the Chinese version of Marshall Plan in this green economic era. So we empower those developing countries as they pursue green transformation. Now, I think the reasoning for this can be divided into 4 parts. It's fourfold. Now, number one, why does China want to do this? Looking back in the history of China, we've always had trade surplus. For a small country, surplus is not a big issue. But when you are one of the largest economies in the world, trade surplus could backfire. It could cause a lot of frictions. There is one European scholar looking at this issue. He said if you hold trade surplus over a lot of other countries, then in the future, your international relations, economic relations are going to be fraught with tensions. Meaning, like, we have trade surplus with over 170 countries. It's hard for China to strike a balance for its own economy. It's not a big issue for small nations, but when it's a big nation, it's a different story. Because when you sell something, that thing will become cheap. When you buy something, that good will become expensive, meaning your demand and supply is going to change the international supply-demand landscape. If you look at the historic context, trading balances can potentially lead to economic and political or even military conflicts. If you can handle it properly, I think the best way to address it is to leave some of the money in a country with trade deficits so as to support their development. It's kind of like a community of shared future from an economic perspective. That is to say, in the short term, if we're not able to properly address the trade balance issue, if China continues to grow, we have to consider this possibility of jointly working with developing countries who suffer from trade deficits for joint prosperity. And the second dimension of this is, green transformation is needed for all, but developing countries face more challenges. They want to pursue this path as the rest of the world, as it's needed by the whole world. Obviously, China is not able to shoulder all responsibilities, but if we are able to contribute our fair share, then we can not only help the developing countries achieve green transformation, but at the same time, it can help China establish a global leadership in green development and gain more global influence.
Number 3, if we could achieve this, then through some tools and vehicles, we could help the developing countries to transform. And we could even encourage them to buy our products and introduce our technologies into their own countries and encourage our companies to go outside, which will, to a certain level, alleviate the excessive capacity issue. And meanwhile, there is a market so that the industries could continue to lead the international industries. And number 4, in this process, we could help the financial institutions and RMB to continue to be globalized. And some experts said if we would like to provide foreign assistance and policy loans, whether we could use digital RMB. And of course, they could buy our products so that the RMB could be circulated, which is a very important mechanism. I think there might be such possibilities, and we could consider such as a choice. And of course, there might be many objections if I mention this. But there is a possibility. But if we decide to go this direction, then there are some issues we have to consider. First of all, there were some criticism saying that in China's overseas funding, some debt pressures were created for the less developed countries. So can we be more cautious in our commercial funding in the future? And meanwhile, when working with other financiers, including other international organizations. Once there are issues occur, we could resolve these issues jointly. And secondly, which is also very important, whether or not we can probably use the sovereignty credibility to provide policy tools instead of direct financing. From this perspective, I think there is a possibility, and of course, there might be experts saying that our financial situation is very tight right now, and you're still thinking about issuing such vehicles or tools. Yes, indeed, we do have financial pressures, but fiscal and current monetary policies' final target is to achieve the overall economic stableness. Instead of not doing anything, just for the purpose of keeping these policy tools stable. Thank you. Thank you, Mr. Huang, for sharing with us the global South countries' development plan, green development plan. With that, we'd like to invite the next speaker, Mr. Liang. Mr. Liang is late due to in arrival because of the flight. He is the China's national think tank chairman, which is the only financial think tank in China so far. The floor is yours, Mr. Liang. Good afternoon, ladies and gentlemen. It's my pleasure to be invited to attend the report, a release of such a report. I'll just follow the what is requested by the organizer to evaluate the report. That's why my topic is some of the issues in China's financial system development. First of all, after the Central Financial Work Conference meeting, a certain logic has been established. Whatever the issues are, economy is the underlying issue. And from the Chinese Central Financial Work Conference, it was identified China's effective demand is insufficient, mainly because of the gap in residents' revenue. And in terms of the macro policies, major focus for our next step work is to coordinate the two systems for the macro control systems. Take a look at the numbers on the chart. And this is the macro leverage ratio. In the past 20 years, we've been releasing data on a yearly basis. And from this data, a lot of details could be read. And from this chart, one impression is in the past few years, the macro leverage ratio increased very quickly, especially last year. You might have a misunderstanding thinking that macro leverage ratio going up means the increase of the financial risks, which is bad. But if you look at the structure, because we're looking at the ratio, there is a denominator and denominator. And the denominator is debt, and denominator is the corporate equity, as well as the residents' disposable income. If we're calculating that for the government, it should be the fiscal expenditure. If it is the whole society, it should be the GDP. And with such a ratios going up, the denominator, it could be the result from the both ends, the denominator and denominator. And so from this, from our analysis, we can see that the going up of the leverage ratio is because of the numerator of the denominator. So the numerator is debt from this chart, you can see. If you study finance, don't worry, because that is something we can never circumvent. It is the target of our focus of our research, or target of our research. especially at the current stage, if the economic entities would like to borrow and they would like to lend as well, that's something we really hope to see. And from this chart, you can see nobody really would like to borrow. And that, hence, there is a previous chart. Debt growth is very slow. And the GDP, which is the denominator's growth, is even lower. That is why the leverage ratio is going up. But it doesn't mean that the financial situation is really bad. It reflected the underlying reason. The real economy is not performing well. Take a look at the residential sector. There are several key points that we can analyze. The first one is the fast growth of the leverage ratio and debt for the residents, especially at the crossing of the centuries with the real estate market development. The residents borrowed money from the banks, and then the debt grew really quickly. And secondly, by 2020, for the resident sector, the leverage ratio in China exceeded that of Japan and that of Germany, which is not really good in a certain way. In Japan, there was such a last 30 years mainly attributed by such an issue of a really high leverage ratio for the residential sector. And now we've seen the real estate sector having a lot of problems, and many measures have taken, but no good results. And thirdly is last year, this ratio is going up, but not because the residents would like to borrow. The major reasons because of the fast declining of the disposable income by the residents. So from this chart, you can see there are consumption loan and property loan and operational loan. In China, operational loan basically equals to the individual business owner's loan. Previously, it was going pretty well, but now all of them are dropping. So all sectors and all economic activities are slowing down. People wouldn't like to get loans, and that is why the already very low disposable income by the residents looks high, and that's why the leverage ratio went up. This chart shows the gap between deposit and loan, which is a heat topic for the past few years. The deposit of the residents went up quickly, and loan growth is very steady and moderate. For the real economy entities, currency and credit, which one is more important? Credibility is credit is more important. One currency is transformed into loan, into debt, into the corporate bond. Could it become a credit? And from this chart, you can see a large amount of currencies were not transformed into credit. And this chart is always misunderstood by a lot of people, thinking China has such a large amount of a deposit. They have a huge amount of money. Then what about invest and providing loans? Your money is different from my money. This amount of money is an average amount. And rich people, the consumption appetite is very different from those people having less amount of money. And that is why there is such a gap between deposit and loan. And for macro control, this is something they wouldn't like to see. They're afraid to see such a big gap. The reason there is such a gap are of threefold. First of all, it shows that banks' major business was providing loan in the past, but now banks' loan providing amount was reduced. And as you can see, because they are buying bonds more. And that is the trend in the past few years. Banks would like to buy bonds instead of issuing loans. And secondly, banks are disappearing. As you know, that China's banks regulation is very stringent. And shadow banking does not have to be bad for the economy, but shadow banking disappeared a lot. And number three, a lot of non-banking activities were returned to the banks. And other financial institutions are not very active except the banks. Banks decline to receive deposits. Some banks even decline to receive deposits. So I was trying to deposit some money, but the bank accountant told me that you have to wait in order to have a quota so that you can deposit your money. It never happened in the past, and which is something I don't think it's good, because there is such a trend that the financial industry is going back to the bank centralized system. And if you look at the China's Financial Work Conference meeting, there is such an implication saying that the national banks should be developing into a bigger and stronger sector. And banks are becoming bigger and stronger, especially SOE banks. But how they are going to support the real economy, that's something we need to focus on as well. And the fact is already fact that the banks become the center of the financial system again. And in terms of businesses, the leverage ratio is still going up. And in a passive way, they're not borrowing money from the banks. That is why the leverage ratio is going up. And non-financial business debt, three types of debts, loans and corporate debt, bonds and total debts are going down. The businesses are not borrowing from the banks. They're not issuing bonds. They're just doing nothing. And this is something we think it is pertinent as important issues.
And also at the same time, the corporate sector is faced with that kind of situation I just described. So that is why the gearing ratio is the way it is. That is cause for additional attention. We have to dig deeper into the fundamental reason why the leverage is changing the way it is and why it is happening in that real economy. And if you look deeper, if you go further, the deposits of the corporate companies also reflect the same issue: term deposit, current deposits. For companies, like, why do they want to save money in the banks? They just need a little bit of liquidity, a little bit of cash for hiring people, paying salaries, buying raw materials, start of operation and production, or maybe a little bit of investment. So in other words, for companies, fundamentally, they just need to hold short-term deposits. However, unfortunately, even for companies, they are saving a lot of termed deposits. So why are they doing longer-term deposits? So if it's a 2-year term deposit, it means that they're not using the money for the next 2 years. The money will just sit idly in the bank. So that kind of phenomena is quite a headache for us. And it's also in line with what the residents are doing. Now, if you look at the government side, even for the government, the gearing ratio, the leverage is going up and up. The government bond market, China is number 2. It's not something we can be proud of. The treasury bond market size is pretty big, but at the end of the day, treasury bond is government's debt. And for the yellow bars, it means local government debt. If you compare with other countries, especially developed countries, the biggest difference is that most developed countries, the majority of their debt is central government debt, federal debt, sovereign debt. So sovereign debt, it's risk-free to a certain degree within that framework. But for local government debt, it carries credit risk. Not just market risks, credit risk. So the structure of government debt in China is a little bit worrying. The Central Economic Work Conference laid out a 4-point guideline for managing government debt risks. And the first of the 4 points is to prevent problems from local government debt. We have to manage it well. Now, most importantly, but when you look at the leverage ratio as it go up, it doesn't mean the situation is worsening. You have to see why is it going up. One of the reasons why the number is going up in China is that the government or proactive fiscal policy is not becoming more effective. It's becoming more aggressive, but it's still lacking that impact. So that is something we have to discuss and figure out going forward. Now, if the central government does not readjust its budget at the mid of the year, then the fiscal policy will be of the same intensity as last year. It poses another challenge. Now, if you look at a financial institution, the financial sector's gearing ratio, we need to look at it. We can look at the debt ratio. We can also look at the asset side. Now, we see a big scissors gap. If you look at the liability and asset side, the liability is getting bigger and bigger, so the gap is getting larger and larger. It means that all the money is flowing back to the banks. Now, if the money is all in the hands of banks, that could be potentially a problem. Shadow banking is becoming, again, an essential part of the system. So in the future, I think financial leverage will be relatively stable. In the short run, due to the slow recovery, it might see some uptick. In the long term, there might be a slow upward trend. But the most important lesson is that the calculation from the asset side and liability side, we see this structural gap, something we call the scissors gap. Now, the commercial bank assets and its gap with M2, broad money supply, M2 is not that informative as an indicator. So if you look at M2, the black line means commercial bank assets, and M2 is the blue line. It used to be like the black line is higher than the blue line, but now it's the other way around. It means that a lot of the M2 money supply has not become so-called credit. That is to say, all the indicators are pointing to the same conclusion, which is that maybe we have sufficient monetary supply, but there is limited credit supply. It's shrinking. Credit supply and the shrinking of that is partially because of the real economy, partly because of the financial sector. We believe the monetary policy is quite progressive and active, but due to limited limitations in the economy, it pushes the leverage ratio, limited the leverage ratio from going up. Interbank lending. The blue line is lending from banks to non-banking institutions. In the past, money is all in the banks, and then non-bank institutions has to take money out of the banks. Now it's the other way around. And the interbank debt is at a very low level. In the last 2 years, it even exceeded the blue line. It's another structural challenge. The financial structure is not even a hidden issue. It's not a covert issue. It's now a very salient issue. There are some big changes taking place in the financial system. Given the economic downturn, the financial leverage ratio might continue to climb up in the short run. Now, looking at this bar chart, this again is about M2 money supply. if the look at the bars alone, there's a very strong stimulus from monetary policies. So some people are saying that Chinese M2, it compares with, Fed and then European Central Bank and Japanese Central Bank. Some people added up all the M2 numbers. I want to clarify, our M2 is not the same as the M2 quoted by other countries' central banks. We use different statistics and different formulas. So Chinese M2 and US M2, we're not doing the same calculation in the same manner. It's kind of like our M2 is their M3, and their M3 definition is going through different changes and adaptations. And then again, like I said, M2 is not a very informative indicator. So monetary supply, there is enough or sufficient money supply, but at the end of the day, it's not converting into credit. This chart shows you another conclusion based on our analysis. As a professional researcher, we don't look at M2, we look at the ratio of M1 in M2. M0 is cash. Cash is something you can spend anytime you want. M1 is M0 plus corporate check, which is based on current deposit. So money that you can spend anytime you want as a percentage of total money supply and how it's evolving, that is reflective of the liquidity of money supply, and it reflects people's confidence of the economy. And that indicator is going down. So accommodative monetary policy is not that accommodative, and the reason is just what I said. We have been coining a lot of new terms, relaxed monetary supply, but limited credit supply. But from a monetary supply perspective, the liquidity is quite limited. I was talking to Mr. Dai, one of the old governors of the bank, and he said there is too much inert deposits, which just means term deposits. Now, after covering so much financial issues, I want to narrow it down. We want to focus more on the real economy. What really concerns me is lack of investment and consumption, which are both in decline. This chart depicts a clear trend of decline. Now, the turning point is the pinkish bar, the red bar. That bar is when the Chinese population demographic started taking a fundamental shift. The participatory rate declined starting that point. President Xi talked about the population issue on many occasions. I think there is fundamental logic. So financial troubles, if you cannot explain it with financial analysis, you can answer it with economic analysis. If not, then you can look at it from the perspective of population or policies. So that explains what is creating a drag on economic and financial development. Last but not least, there's another picture. In April, IMF published its new World Economic Outlook, which is different from the March version. It's a little bit negative to us, less favorable than the March edition. In March, it was said that China was the main driver for the world economic recovery. Now, in the April edition, in 2023, 2024, 2025, they're seeing a downward trend across emerging markets. So that is a very dangerous signal to us, but we're not afraid. We have President Xi, CPC, we have the strong leadership of the CPC Central Committee with Comrade Xi Jinping at its core. And so the real economy, we're really need to address the real economy challenge through reform and opening up. We must not rely too much on financial means and tools. We must not rely too much on fiscal measures. We have to let the real economy improve through reforms. Just a couple of days ago, President Xi Jinping had a meeting on the reforms of real economy, and that meeting gave us a lot of positive signals. And I think with the leadership of President Xi Jinping, with all the measures they plan to take, it will be able to help us take a turn for the better. It will be able to revert the trends in the economy, and Chinese economy will continue to thrive and shine. So I welcome your feedbacks. Thank you so much. Thank you so much, Mr. Li Yang. It's such a great opportunity to listen to your presentation. It's been a very rewarding session. Financial challenges have to be addressed and explained from the economic perspective. There are some structural traits and qualities we have to take a look at. And at the end of the presentation, Mr. Li said, reform is the way forward. And during the April 30th Central Politburo meeting, and just a couple of days ago, President Xi said again that this year marks another important year for reform and opening up. We have to break through the institutional obstacles and address the structural challenges. So Mr. Li Yang covered the whole chain of financial, economic, and reform development. I think it's a very insightful session, a very insightful presentation. Now we have listened to Director Tu, Ding Huang, and Mr. Li Yang, Professor Li Yang. Last but not least, the last speaker of our session, last but not least, somebody from the corporate side, Chairman of China Zheshang Bank, Mr. Lu Jianqiang. And the topic of this presentation is finance for good against the cyclical currents. What a great occasion. We have so many important dignitaries in the room. It's a great day for the financial sector in Hangzhou, in Zhejiang province. And the topic of today's session is also very important. And a lot of the speakers and participants are people I admire in the industry. As for the theme, we talked about internationalization. I'm a Hangzhounese born and raised in this city. And on behalf of all the people in Hangzhou, I first would like to extend a warm welcome to all of the participants. At the same time, I want to deliver something unique to the city as a gift. In the last 2 to 3 years, the financial sector in Zhejiang and also my company, Zhejiang Bank, we have been exploring the path forward, and we really need some feedbacks and input from you. So the topic of my speech today is finance for good through anti-cyclical terms. Recently, we have been learning a lot of lessons from the Central Financial Work Conference.
The eight insists on making China a powerhouse for finance and adopt a Chinese way for development as well as six service system. And these are all spirits provided by President Xi Jinping. And in terms of our understanding of finance and positioning of our financial sector, we prioritize the functions of it, especially as mentioned by President Xi Jinping. The financial sector's development should be not only looked at from the financial nature, but also from the social and economic development perspective. So there are two major backgrounds. The first one is the positioning of the finance in a new era, and the second is the changes of digitalization. And we've been in a development process of the financial sector, but in the following stage there might be some counter-cyclical stage to be coming, and what should be our solutions. And I think we should look at this, look at the solution from two perspectives. The first one is from financial oriented concept, and the secondly is smart operational concept. In terms of financial innovation, we need to proceed the financial institution innovation from the perspective financial development. And from a Zhejiang Commercial Bank, we focus on demand. And by following the related theoretical guidance, we first of all put the functionality of finance as the first nature for the financial sector, and trying to promote the 4 major practices. The first one is establish the financial advisor system. Starting from the year 2008, we started the pilot in Zhejiang province. At that time, the risk prevention work started for the financial sector. We invited a lot of professionals trying to help us to design and resolve risks. But we also incorporate the professionals as advisors after providing trainings to them, and then giving them some different positions. The first one is the family doctor, and the second one is the government financial expert, and number 3 is the residence financial advisor. And these are the 3 positionings for the financial professionals. And all the financial institutions are license-based professional service providers. How can we make us a more comprehensive service provider? So whatever the decisions were made, they were not focusing on the demand from the customers. And the government didn't have too many financial experts, and most of these experts are working for businesses, including those experts in a financial office of ours. So we didn't have too many financial experts. That is why we proposed these 3 positionings of the financial professionals in order to provide some social titles to them. So we have almost 1,000 financial advisors right now for the Zhejiang Commercial Bank, but they are not dedicated their services to Zhejiang only. They're also serving the Zhejiang province and other provinces. And we started this pilot program, and the first batch involved 55. And now, in the second stage, the number has been increased to 4,000. And in terms of financing, we provided financing to 5,000 companies. And we also provided the solutions to help those difficult businesses to resolve their financial risks, and by providing the financial intelligence to them. So this is another area that we provide the financial intelligence. And secondly, by following the previous mentioned system, on the county level, we explored a model of comprehensive business, comprehensive financial ecosystem construction. Within our Zhejiang, there is a district, and the eco-environment is very balanced. And I had a partner to work with, and we started this Linping Financial District pilot zone. And most of the financial sectors are far away from the county level. And that's why in the county level, we were trying to figure out what are the financial demand. I felt that we need to provide foundation service, financial service to the county level as well. And starting from the year 2022, now it's been 2 years, and these are the 3 innovative directions. First of all, we established the investment division where more than 10 people are working together to do research on the LGVs and to come up with the financial sector's operation quality for the county level. And Zhejiang is well digitalized, and we help those businesses to analyze their funding requirements. And then we came up with a new financial tool, financial service, 金融宝, financial services provided to the SMEs. So that for the SMEs, the financial institutions and including the intermediaries are working together on this platform. Number 3 is from the social side. And we've organized 300 of training sessions on the county and the village level to make sure wealth management trainings are taught to the local people so that there will be no fraudulent cases. And hence, we established this 3386 model and connected the financial services to the local people from last year's perspective. And the interest rate dropped by 58 BPs for the SME loan. And the profitability increased by 30 BPs. In February, Professor Wang was there in person, and we organized a workshop, and the practice have been well recognized. And in last month, in the Hangzhou Financial Work Conference, this pilot is going to be further expanded. And Zhejiang Commercial Bank has 36 branches, and we're going to select a county at our outlet in order to provide this kind of service. Number 3 is to establish a Zheyin Shanbiao system in order to continue to deepening the financial service and expanding the financial services from the social value perspective. And capital expansion is out of order, but underlying that is the financial institutions' pursuit for profitability. That is why, starting from ourselves, we are conducting this social value evaluations from 3 perspectives. The first one is we have a corporate version and individual version, the family evaluation, industrial evaluation. If the evaluations are not good, and you will not become our clients, and especially those clients that do not have high scores, we will not make them our clients anymore. So connecting to our risk management system, this has become a very important endeavor for controlling the risks. And a lot of SMEs do have difficulties and risks, but we still would like to provide loans to them. But for those big companies that are very active in the financial sector, a capital market, we wouldn't like to provide services to them because there might be interfering with the social order. And we are further promoting this work year on year. And for those goodness index, whoever gets high scores, they will be retained as their customers. But if they're low in terms of that the index ranking, then they will not become our customers. And number four is to implement the goodness or based trust project. And we've been thinking about how are we trying to help joint prosperity. But sometimes when we try to help, we exacerbated the situation. So we were focusing on 2 major issues that could be addressed by finance. First one is to address the non-balanced, non-sufficient development. The second one is to play a prominent role in shared ecosystems. And there gaps might create some social disrupt. Previously, we didn't have solutions for the gap creation. Gap created is not a major issue, but for those rich side, they should play a positive role so that their wealth could be better used. Therefore, for businesses, each businesses, on one hand, they are continue to operate. On the other hand, they contribute to the charity work. What are the work of charity? There are 3 scenarios for this company to contribute for charity. First of all is, for example, the providing services to the people within the company. The second one is to contribute to the resident areas where this company is located, or the place where the entrepreneur was born. So these are the 3 different scenarios. And under these 3 scenarios, we explored 2 types of charity work. And from May of last year, we started 3 projects. And at the beginning of this year, we made a deployment of 150 projects. My hope is China's entrepreneurs could exceed that for in the Western world in terms of their contribution to the charity work. So they not only created wealth, but also value to the local people. If we can address this problem, I believe we could achieve the social harmony. And these are the 4 pillars for the goodness-oriented finance. And apart from these 2, we do have other areas. I'm not going to go through the details. So this is the first part of my presentation, looking at the finance from the value perspective. The second one is to transcend the cycle. Digitalization is a good opportunity, but especially in the downturn of the economy, we need to focus on the less sensitive assets against the economic cycle. And we conduct analysis and came up with a chart related to the sensitivity. And also, for if by 2027, we hope the number of sensitive assets could reach 75, because economy.
但是从整个中国的经济来看呢，大的来看啊，好像一个周期都没走完。
We have not finished even one cycle. So it used to be like 60, 70 years per cycle, but China has not run through its initial cycle. So that is why the banks have to learn our lessons. And we started planning the so-called less sensitive assets for pro-cyclical development. And when the economy is good, the banks will have good times, but we're not going to be the best of the best. But when the economy is down, we'll be able to be more resilient, because it's not going to be a worst-case scenario. That is what we are talking about by having less sensitive assets in cyclical fluctuations. And in addition, we have so-called smart management sheet and also digitalized revenue financial statement. So we are seeing an expansion of digital products as part of our revenue. So we have 3 new financial statements as part of the bank's operation. At the core, it's about riding safely and steadily through the cyclical fluctuations. And so that is what I want to share with you today. That is what China Zhejiang Bank is doing, and what the Zhejiang province is trying to reform and deliver. We have accumulated some practical evidence and practices over the last several years. I think those approaches are effective and very useful, but they require theoretical guidance, and we have to learn to integrate it into the overall financial development system of China. And that is why I'm sharing the system and philosophy with you. I hope that all the top-notch experts in the room can share your insights with me to help us fine-tune this methodology. Thank you. Thank you so much, Mr. Lu. Your unique gift from Hangzhou is more than just a gift. yours is the most excellent summary of the practices of what Zhejiang Bank has been doing, how to ride through the trends of cyclical fluctuations, how can you use less sensitive assets to play it safe and steady. So just now in the first session, we heard from Mr. Ding Zhijie with the report launch, and Mr. Li Yang and Mr. Tu Shanghong, who talked about the key 3 pillars, and Mr. Huang and talked about another dimension of financial sector, and Mr. Lu talked about how to better ride through the fluctuations. Now, let's move on to the second plenary session, which is about finance empowering technological innovation. Now, thank you all for listening to the first session. As the moderator, I'm going to give the floor to the moderator of the second session, who is Mr. Liu Bibo, Associate Professor and Assistant Dean of Tsinghua PBC SF. Let's welcome Mr. Liu Bibo, Associate Professor and Assistant Dean of Tsinghua PBC School of Finance. Distinguished guests and participants, good afternoon. Welcome to the Bretton Woods, 80 years after Bretton Woods, 80 years after Bretton Woods international development of financial system. And we're entering the second plenary session of this Building International Monetary and Financial System for All conference. And I would like to briefly introduce the guests of the second panel. And first, we have Mr. Zhang Xiaohui, Vice President of China Society for Finance and Banking. And then we have Mr. Qian Xuan, Chair Professor and Associate Dean of Tsinghua PBC SF School. And then we have Mr. Liang Kang, Secretary General of Jianxin Leadership Strategic Emerging Industries Development Fund Expert Advisory Committee, former Director of Department of Laws and Regulations of the Department of Employment, Income Distribution and Consumption, and National Development and Reform Commission. First, I'd like to give the floor to Ms. Zhang Xiaohui, Vice President of China Society for Finance and Banking, for her presentation. Good afternoon. It's such a pleasure to be here and share my insights with you. The topic of technology innovation is such a buzzword. Well, I'm obviously not an expert on innovation or technology. Maybe the organizing committee figured I did a project on a relevant topic, which is about how finance can be of support to technology, so that's why they invited me. How do I use this to, how do I turn the slides? I'd like to approach this topic from 4 perspectives, just sharing of my observations, what I've learned along the way in my capacity. Technology innovation, both in academia and in the corporate world, is a very important topic. A lot of people focus on how technology innovation can play a role in developing or promoting high-quality development. From a perspective, we can see that technology innovation is one of the key drivers for modernization and development. If you look at contemporary history of human race, we have already experienced 4 major technological revolutions. Since the 18th century, there have been 3 major technology revolutions. So the first 3 are in the past. We are now going through the 4th technological revolution. The first one, which is known to all, is marked by the invention of steam engines. And the second was marked by the development and use of
electricity and telecommunication. And the third one was driven by IT, or information technology. After the turn of the century, with the development of artificial intelligence, quantum information, big data, all those new technologies are becoming better and more mature. I think it's fair to say that the humankind is going through our fourth technology innovation revolution. Technological innovation determines a country's economic strength and comprehensive national power. Since the first revolution in the 18th century, if you look at historical context, as long as you're able to seize the opportunity presented by technology revolution and achieve homegrown innovation, then this country, this economy will see a significant improvement in its national strength. At the same time, it is contributing to some changes and shifts in the geopolitical landscape. Now, one example is the UK, the British Empire, which was described as a kingdom where the sun never falls. And the success of the British Empire would not have been possible without technology revolution. And then if you look at the US, the rise of the United States was attributable to the Second Industrial Revolution. In the 100 years after Second Industrial Revolution, US experienced a boom in its national strength, driven by technology innovation. In the early days, the US relied heavily on Europe for fundamental research. But the US managed to use European research outcomes wisely to boost its national strength. After the two world wars broke out in Europe, and just to emphasize, it took place in Europe instead of US. So that's when a lot of scientists relocated to America. And America got an injection of a lot of high-caliber technology talent. The movie last year from Christopher Nolan, Oppenheimer, was an example. A lot of the bright minds decided to immigrate to the United States. And that helped to boost the U.S. technological and scientific strength. Beside what I just talked about, another advantage that comes with technology innovation is that it can help determine whether this economy is going to play a dominant role in the setting of international rules and rules and norms. As we know, technology is essential to the country's hard power. It's also critical for the country's so-called soft power. As we experience unprecedented changes unseen in a century, technologies are becoming increasingly intertwined with national power and security. In key areas, technologies will play a determining role for the country's fate and whether it is able to play a key role in rule setting on the international stage. Previously, a country's path was more determined by its natural resource endowment, but now I think national strength is more a function of not just natural resources and wealth, but also how much the country has to offer when it comes to key strategic technologies. So innovation can lead to breakthroughs and lead to more innovations down the road. There are many examples, but in the interest of time, I'm going to skip this part and not give you a list of all those examples. But one thing I want to highlight is in the morning session, we recapped what happened over the last 8 decades regarding the Bretton Woods system. Part of it is about setting a rules for the international arena. The Washington Consensus, how did it come from? It has a very close tie with the United Nations. It has to do with the Washington Consensus is about how the United States using technology and inventions to craft its soft power. So technology innovation determines whether a country can play a role or have a say in setting the rules for the world. Another very important dimension of technology innovation is about whether a country is able to emerge beyond the middle income trap. As we know, the middle income trap requires a shift in the economic development paradigm, improvement in industrial mix structure, and accumulation of talent and human resources, aka four-factor development. But at the same time, it also relies on leveraging technology and scientific development for economic growth. So I believe technology innovation is one of the most substantive or most clear manifestation of that process. I have several examples. A positive example is Japan and Western Europe. So after the second round of technological innovation, or the momentum from that depletes, Western Europe fell into a middle-income trap. But after its reforms in the 1950s, it managed to launch or commence another technological revolution, which helped it to emerge beyond the middle-income trap. And then Japan is the same case. In the 1970s, Japan started to shift from trade-oriented development to technology-driven development with a focus on training more tech-oriented talent in its education system. That shift helped Japan break through the middle-income trap. That's how Japan got lifted from the middle-income trap. In 1960s, Japan was the second largest economy in the world. And then in the beginning of 1970s, the per capita GDP was 4,000 RMB. At the end of 1980, as it emerged from the middle-income trap, its per capita GDP exceeded 12,000 US dollars. It only took Japan 15 years to go from 4,000 to 12,000 in per capita GDP. That goes to show how strong innovation can be. A negative example is actually Argentina. At the beginning of the last century, Argentina was actually the third largest economy in the world. It was rather successful. But back in the 1930s, they used a strategy called import substitution. It did not really devote much resources to technological development and building its own labor pool and quality labor. So that is why its industries got stuck. There is no upgrade, there is no elevation. So in the 1980s, it opened up its market in a blind manner, and in that process, it lost its own comparative advantage. Coupled with turbulent political situations, Argentina was trapped in that so-called middle-income trap and also a debt crisis. And another thing I wanted to share with you is new quality productive forces and how that has to do with technology revolution and innovation. It's a hot word, buzzword these days. I think technology revolution, when it comes to productive forces, technology plays a profound role for the development of productive forces. In the fourth technological revolution, we can see that social productive forces is experiencing unprecedented changes.
And therefore, there is new requirements for the productivity or productive forces. And President Xi mentioned that China's innovative capacity is not strong enough, and the overall level of science and technology is insufficient. And the contribution to the economy by the science and technology is far lagged behind compared to that of the developed countries. So this is the Archelaus Heo for China. This god of Archelaus is the weakness of him is located at the heel, and that is the weakness of China as well. Especially in development of in the process of development, what our weaknesses are, where do they located? Are they located? In September 2023, President Xi was proposed the new quality development, productivity concept while he was visiting Heilongjiang. The so-called new quality productivity refers to the productivity that is based on new production tool, new production environment, and new production forms. And in December of 2023, in a Central Financial Work Conference, the new quality productivity also was stressed on. And in March of this year, in the 11th collective study by the central government, President Xi Jinping made new requirements over new quality productivity. New quality productivity and what its relations with the science and innovation. It is the core element for the innovation. In a new round of revolution, science and technology is driving the innovation, and new opportunities and challenges have been presented to China. Especially in the past few years, China has been promoting the strategic new emerging industries, and science and technology and innovation have been developing, but still lagged behind compared with the developed countries, and especially against today's environment, especially with such a chaotic geopolitical environment. China, the world is entering into a geopolitical, technological era, because at the critical areas where countries leads in terms of their science and technology, they could achieve success in the international competition. That is why China needs to develop a new quality development. For the new quality productivity, what is the core concept of it? I would like to briefly share with you briefly. Innovation plays a leading role. It helps us to get rid of the traditional economic growth model and productivity development pathway. It has the feature of high-tech, high efficiency, and high quality. It is in line with the advanced development concept. It includes 4 areas. First one, the signature of it is the improvement of the all-factor productivity. And secondly, science and technology innovation is the core concept for the new quality development. And industry upgrading is the major support for new quality productivity. And fourthly, it is also green productivity. Technology innovation is critical for achieving new quality development, because only through developing the proprietary and disruptive innovations, the critical technology could be well grasped, so that we could get rid of the bottleneck and we could achieve new quality development. The focus of developing new quality development, new quality productivity, is to nurture talents. And we need to establish a benign circle of development. And we need to nurture a good eco-environment and business environment. So 2 key issues are technology and innovation. And finance for the new quality productivity development, what role does it play? The answer is simple. Most importantly, it could optimize the allocation of resources and to improve the efficiency of resource allocation. As we know that the finance is the bloodline for the economic development and a very important part for the national economy. Therefore, the core function of finance is to optimize asset resource allocation, so that we could coordinate and integrate the productive factors and promote the circulation of the factors and promote the coordinated development between different regions. So this is regions, and these are the core function of finance. Given it could help optimize the allocation resources, how can it promote the technological innovation? Fintech. Technology innovation finance is a new concept, therefore proposed. It plays a very important role for encourage innovations. So what about the technology innovation in the finance right now? So far, it is still focusing on the indirect financing by the credit loans. And one of the major features for it is financial sector is returning to the banking sector. And the technology finance major force is still the traditional financial institutions, including the banks and the insurance companies. They provide loan support for the SMEs' technological innovation. There are some VC funds, the direct financing channels are only serving as auxiliary channels. And secondly, in terms of technology innovation, basic research and critical technology breakthroughs, the government has invested a lot of money, be it PBOC or Ministry of Finance. They invested a large amount of fundings and institutional supports. But what is the current situation? Technology innovation and technology innovation finance is not in line with requirements of science and innovation funding requirements. The total investment is huge, but there are structural issues which was decided by the features of the technology innovations, because it needs a large amount of investment and having a lot of uncertainties, long-term of return horizons, and different innovations might have differences in many different areas. But China's funding channels are very limited, and the major forms of financing are still indirect financing from banks and insurance companies. And therefore, the supply and demand structure and are not matching each other. Equity funding represents small part, and therefore for the seed-level companies, they couldn't cover a lot of company. And innovation finance is very important for fintech, but there is a major weakness. What is it? Finance support innovation means that it is a lack of capital instead of funds. There is no sufficient direct financing, and general public do not have much financial services. That is why, against the background of operating by dividing different sectors, and the financial sectors of from the capital market perspective, it is not developing by fully following the market rules. Therefore, it is not only cannot support large amount of innovative companies listing, nor does it support the corporate governance of those listed companies. And most importantly, there are some speculative SMEs to cash out in the name of technology and innovative financing. And even though these companies' size are big enough, still these capital are big enough, but there is no sufficient human resource and products supporting the technology innovative financing or SMEs. There are some dedicated people from the banks working on the innovative financing, but the number is limited and cannot meet the requirements for the market. And secondly, the major investors, especially institutional investors, are not mature enough yet. Number 4, the risk investors' development does not have a long history, and now it faces such a problem of related to the funding, fundraising, investment and management, and exiting, and therefore there is a lack of legal basis as well as high net worth people. So what shall we do? We need to continuously improve the technology and the innovative financing system with Chinese characteristics. The 2 work need to be done. First one is we need to establish a good enough eco-environment. And secondly, from the business and projects level, the innovations with different life cycles might have different features. Therefore, it needs different forms of financial support. And in terms of a public sector, the support focus of the support to the technology innovation finance, they should put on the funding environment. Because the public funding of public sectors total investment is not small, but they need to put the money into the improvement of the funding and the financing environment, because innovation has a lot of complexity. But capitals are looking for profits, and we need to provide sufficient incentives to the market. If a large amount of public sector capital just to go after these innovations and technological innovation, there might be a huge amount of waste. And therefore, we need to, first of all, establish a good environment by using the public money. And government-guided funds also provided a strategic position for the innovative companies. And the strategic positioning from the government is very important, because it mainly plays a role to guide the market. You cannot just look for short-term profits or short-term target. Otherwise, not only you're not playing a role of a guiding fund, but also squeezing a lot of other funds out from the market. And this is something the government needs to consider. And secondly, we need to reduce the limits for the investment. Certainly, in terms of the government-guided funds strategy for investment, it shouldn't focus on mobilizing private capital or private funds. And from the macro level, we need to consider that. In the operational level, what we need to consider is
and the financing management and the access, all those things are where the government-led funds can play a leading role. And there are some weak links that we have to strengthen. For example, lack of direct financing, because direct financing satisfies science tech startups needs the most. The most effective way is to there are 2 ways to support them most directly. The first is the capital market. The second is equity investment fund. And in different forms of technological innovation for finance, the equity market typically plays a salient role in its support to tech talent and entrepreneurial development. But for the IPOs, tech and innovation companies are not that big a percentage of the companies that are pursuing IPO. That is because of administrative industry orientation. It limited the stock market's ability to support science and technology firms. Sometimes a company is not in one of the key industries. That is why it's not able to go public. Equity investment funds have high tolerance for risks, great discerning capability for science technology projects, advantages in capital risk management and flexibility in exit channels. Those equity investment funds are a very important source of financial support to science and technology startups. So that is why this is one of the focus areas for our endeavors. The capital market has several tasks on its plate. First, it has to adopt a multi-tiered capital market development approach. Second, we have to fine-tune the operational mechanism of the STAR Board and Science and Innovation Board, further differentiate the IPO requirements for different companies, and enable these non-main board segments to contribute to the breakthrough of key technologies. And for the New 3 board, it's also a very important agent for supporting science technology startups. When it comes to equity support, we have to first address the difficulty in financing. That is the first requirement. And secondarily, you have to improve the post-investment management. Investment, management, and also exit. These are the other 3 links that are essential to this chain. And here in China, indirect financing is still the dominant form or paradigm of financing activities. Previously, Mr. Liang mentioned that if you look at the modality of development, he also quoted President Xi's words and some documents from the Central Financial Work Conference. I think it's been very clear that in the next stage of development across Chinese financial institutions, banks are going to play the leading role. Are banks able to support those technology startups? I think yes, but there are some weaknesses that we have to address. We have to put in more efforts to guide the banks to support technology startups. After all, banks play a leading role in this aspect. So from the design of mechanism, the compensation for risks, supportive policies, we have to ensure that there is reasonable arrangements in all those areas for adequate support to technology startups. First, we have to establish a favorable institutional arrangement for supporting technology startups. Second, we have to give play to so-called finance intermediaries as information service platforms. In other words, institutions like banks need to have access to information about those technology startups. And thirdly, we need to have a mechanism for risk compensation. Most of the technology industries are low in assets but high in risks. So for banks to invest in technology startups, they will be exposed to greater risks compared to if they invest in KA customers or individuals. So there needs to be a risk composition mechanism. For example, some guarantors with state-owned background to compensate for the additional risks taken by the banks as they support those startups through investment. So finance as a tool to empower technology innovation is all about dealing with innovation finance, new quality productive forces, and innovation. We have to figure out how those different elements interact with each other, and in the end, then we're able to elevate the comprehensive development strength of the country and make sure that in today's geopolitical context, China will be able to play a role in international rule setting and hold our own sway. Thank you. Thank you so much, Ms. Zhang, for your presentation. Next, I'd like to give the floor to Chair Professor and Associate Dean of Tsinghua PBCSF, Mr. Tian Xuan. Ms. Zhang, do you still have the remote control? Well, thank you so much, Mr. Liu, for your kind introduction. And again, I'd like to thank the organizer, which is also my employer, Tsinghua PBCSF, for the invitation. Now, I want to talk about how to leverage technology finance to support new quality productive forces. I know we're way behind schedule, and as the moderator, I think you're very disappointed. I'll make sure that I'll wrap up my session before 4:32. I'll just take 10 minutes to deliver my presentation. Now, just now, Mr. Liu, Ms. Zhang has already given us a very good summary of what is new quality productive forces. So to develop a financial power, we have 5 pillars. The first is technology finance, meaning how can we leverage financial power, financial tools, financial means to support technology innovation to develop so-called new quality productive forces. In my mind, I think there are several internal factors we have to look at. Internally, we're seeing a shift in China's development paradigm. This chart shows you China's GDP from 1978 to last year in the first 32 years, so there's ups and downs. So there is a line dividing it into 2 halves. Overall, the Chinese economy has been going up and up, experiencing double-digit growth over the last 32 years. And it's a kind of miracle in human civilization. And after the Cultural Revolution, the Chinese economy was at collapse. But in 2010, China exceeded Japan, overtook Japan as the world's second largest economy. And there was a period when China experienced mid to high speed growth as our new norm. So gradually we're seeing some downward pressure, a slowdown, 8%, 7%. Take 2019, for example, which was the year before the COVID pandemic. The 4 quarters had respectively 6.4, 6.26, and 5.9% GDP growth across the year. Even without the pandemic, our economic growth was already slowing down. But with the pandemic, it's kind of a double whammy, and sometimes we had a high year and a low year, but over the last 4 years, we had an average of 5% GDP growth. In other words, China's GDP growth has already slowed down. We are shifting from high speed to high quality development, and that is completely driven by technology innovation and upgrading of traditional sectors and fostering of new emerging industries and planning for future strategic industries. Now, that was more what's happening in China, and with also external factors. If you compare Chinese and US GDP, now you have to look at the right axis. We have always been like in the old days, China was always like 10% of the US GDP. The years after reforming and opening up, the Chinese economy was still rather small. So in that period of time, China was just 10% of the US GDP. After our successful accession to WTO, the Chinese economy started to take off in 2019. We finally exceeded 60% of US GDP, and then we hit 77% in a later year. A lot of experts have been talking about this competition between China and the US, which has become an irreversible trend. In other words, the obstruction of US against China is not going to change due to the shift in US administrations. Nothing's new under the sun. We always know that as the second runner-up tries to catch up with the front runner, the leaders will always try to crack down on the second player. So it's just how the UK dealt with US and what the Netherlands did back in the old days. So given that historical context, the US is trying to build a policy of high walls, small courtyard, and all those restrictions means that China will have to rely on ourselves to boost our new quality productive forces through innovation. And if you look at all the technological restrictions, entity list, all the competition acts, even though China has been transforming ourselves in our position of the supply chain, but we still hold a low position in the value chain. We only have 0.01% compared to 0.29% of the United States, which means that a lot of the key components and technologies are still where we face bottlenecks. Last year, our innovation index ranked 12th in the world, which is a decent number, but still hundreds of technologies are where we face difficulties and challenges due to a lack of access to technology. And additionally, our country is not known for our technology companies. If you look at the top 10 countries, top 10 companies in our Chinese stock market and U.S. stock market, this is number from the end of last month. If you look at top 10 companies in terms of market cap on the Asia market, number one, without question, it was the Moutai Chinese liquor. But some people are saying that, other companies might overtake Moutai. But anyways, Moutai Chinese white spirit liquor was number one, and then we have the PetroChina, followed by ICBC Bank, and then Bank of China, China Agricultural Bank. So basically, there is only one technology company among the Chinese top 10, which is CATL, the battery maker. All 10 companies on the U.S. side are technology companies, and then Microsoft alone, and it has 2.8 trillion. It's more than all the top 10 companies in China combined in terms of market cap. It's almost 1.87 times of the combined total of Chinese top 10. So we have to make sure our companies become more innovative. So we hope that the technology-oriented companies can go public. We have financial power to support them. That is a very important thing to achieve. At the same time, to develop new quality productive forces, national policy is important, but private sector is also essential. We have 5, 6, 7, 8. We've contributed 50% of tax revenue, 60% of GDP, and 70% of technology renovation, which is the topic of today, and that also contributes 80% of employment and 90% of the number of companies in China. If you look at the Yangtze River Delta, we're here in the Zhejiang province, which is part of the Yangtze River Delta, and then in the Pearl River Delta, I think those numbers will be bumped up to like 60, 70, 80, 90, and 100%. So the confidence in the private sector of the private entrepreneurs play a key role in promoting technological innovation. So how can we inject that confidence into the private sector, make sure they get a confidence boost? In the short run, obviously, we're going to rely on the policies. We have to rely on the so-called hard support from the government. We have policies, projects that will give the private sector more confidence to deliver on those projects. The NDRC also specifically set up an administration for the promotion of the private economy, and the enactment of the private economy law also provided a lot of foundation in that regard. But the true driver for the private sector to take off is the soft support. It requires fair, competitive landscape, sound business climate, and predictability in the policy, stability, and orientation consistency. All those private entrepreneurs, they have pulled ahead from a lot of other competitors. If you look at PBCSF, we have a lot of graduates from top-notch universities. But if you look at the EMBA students at Tsinghua PBC School of Finance, their background might not be as spectacular because they are more like the leaders of their companies. They are not from the academic background. Their success was not simply dependent on the national policy support, but also a fair business environment. A very simple piece of statistics was that in the first half of April, our EV sector, be it wholesale or retail, and EV penetration exceeded 50%, 50. That goes to prove that the electric vehicles have already overtaken combustion engine ICE vehicles. That is already an unstoppable trend. EV will take the place of gas vehicles. But back then, people were not that optimistic about EV.
And Tesla just started making profits not long before. So it's a long-term innovation process. But just because this EV and battery were not considered very profitable at the very beginning, that is why the threshold of entrance is very high. And for example, BYD and SAIC are trying to compete in this market, and a lot of enterprises are trying to compete. That is why new EVs are emerging, and the policy stability is very important in this regard. So these are the research we've done. Policy uncertainty and certainty and its impact over long-term investment. We used 42 countries' data to find out the policy from the country does not have any impact over innovation, be it leftyism or rightyism, aggressiveness or conservative. It doesn't matter. if policies from a country have been set, the entrepreneurs could adjust their investment decisions to meet with the macro policies. But if there are uncertainties, we don't know what the future policies would be, aggressive or conservative. What we can do is to wait and observe and do short-term investment instead of long-term investment. That is why we think we need to stabilize the entrepreneurs by coming up with expectable and stable policies. That is very important in terms of reshaping the production relations and promote the modernized industrial development. But why do we mention about innovation against such a background? In 2020, we come up with the 2030 long-term development goal. And by 2035, our per capita GDP will reach the mid-level of the world, which equals to that of Portuguese and Spain. And the per capita GDP is 29.6 thousand USD. And in China, the per capita GDP was only 12.7 thousand RMB, US dollars. And in the future 12 years, the CAGR rate should be 6.7%. But in Renmin University, there is a team which forecasted the potential growth rate was only 4.3% for in the future 12 years. If we follow the business as usual, then the growth rate can only be 4.3%. So what we can rely on is innovation. And Xiaohui has given us a very in-depth discussion about what innovation is. To its core, it is exploration over unknown paths from 0 to 1, from 0 to non-zero. So it has long cycle, great uncertainties, and a high failure rate. And if you use the performance contract to encourage innovation, it is not successful. There is no such one-to-one equivalence. However, whatever you invest, you will get return. So we need to come up with the innovative way to incentivize innovation. And I'll share with you one example. There was a scholar who visited super entrepreneurs, which are the founders of unicorn businesses. And these 100 super entrepreneurs' characteristics were summarized into the following 3 categories. As you can see, the green highlighted adjectives are the features for these super entrepreneurs, which are considered positive: young, aggressive, full of imagination, and product-focused, and persistent, and curious. The yellow highlighted features refers to the neutral attributes, for example, not from a very good family, and also very obstinate, negative, always negative, and whatever it is, they only rely on themselves. They're very frugal, and they are lack of sense of security. The red highlighted attributes are considered negative. They're crazy. They are untraditional, and they are lofted and not easy to get along with, because these entrepreneurs. Sometimes they have to have some features that are not usually seen in common people, in general people. Sometimes those features could be negative. For example, those on Musk and Steve Jobs and others. They are made of a special material. That is why I used to give lectures to my students. Most of the graduate school students at PBC Finance School of Wudao are of the highest quality. The process was very selective, and I told them all your classmates are super good. But if you think your classmates are suspicious and crazy and non-traditional, you have to treasure them. If they want to borrow money from you, you don't lend money to them. You should buy the stocks from their company. Maybe he is the next person who will be successful. So technological startup companies are difficult to establish, and there should be financial support to them. But there are some debates. Financial sector are looking for short-term return, but scientific, technological startup companies are looking for long-term return. That is why we need to be patient, as mentioned by President Xi Jinping in his one of his speeches. And how can we use the financial approaches to support the technological innovation? First of all, we need to focus on financial system from the macro level, and financial systems changes might impact innovation. From the medium level, we need to focus on the market, financial market, what the market players impact over the innovation. Number 3 is from a micro level, which is corporate strategy. This is my last page PPT. And the overall framework covers the 3 different levels, macro level, micro level, middle level. So how the finance could support technical innovation? We need to establish a cultural system to tolerate failure. Venture capital, if it is tolerant to failures, then those invested companies' innovation quality and quantity are of the best. And secondly, we need to not only focus on, we shouldn't focus on the return for 1 year, 2 years, but 10 years and 20 years. And secondly, we need to have a brand new CV, or which means companies should start to focus on the innovation and technological innovation. And there is no pressure of exiting for this fund. And CVC supported business innovation are of a higher quality. Number 3 is we need to come up with appropriate human resource policy. Human capital is very important for innovation, and its importance is 6 times that of the organization capital. And talents, especially, should be incentivized by shares and stock options in order to incentivize the talents to innovate. And from middle level, the not so active secondary market, capital market, first of all, should be supervised. And the secondary market shouldn't be that positive in order to protect these innovative companies to focus on long-term innovation instead of a short-term capital interference. For example, we should have a strong anti-hostile buyout terms and conditions, and we need to have a low share liquidity, and we should need to have long-term holding institutional investors, and not so frequently information disclosure report. By using these tools, not so active from the not so active primary market, the financial innovation could be well protected. We also need to have a comprehensive and complete legal environment. By following the contract, the spirit of contract, governance. And especially, we need to strengthen the production of the private sector entrepreneurs so that they could be dedicated their focus to innovation. We also need to establish a healthy and open capital market, which is exactly the same as mentioned by Xiaohui. Long-term equity investment is plays a better role than the debt investment for the innovation. And now we are we would like to give a full play to the directed financing. And if the government asks the banks to provide loans to the SMEs, and of course in China we could achieve that, but banks by definition has not such a balanced revenue and expenditure, and the bad loan, non-performing loan could cause some bad impact over the market and society. So we need to focus on the direct investment development. Last but not least is a stable macro policy guidance. Entrepreneurs are not concerned about how the policies are, but they are concerned what the policies, whether or not there is a policy. So we need to come up with a stable, consistent policy so that the market expectation could be stabilized. So these are the portfolio from the financial sector to support the portfolio measures from the financial sector to support innovation. That's all. Thank you very much. Thank you, Mr. Wang. Now we would like to give the floor to Mr. Li Kang. From NDRC to to deliver a speech. Good morning, ladies and gentlemen. It's good afternoon. It's my pleasure to have this precious opportunity to attend the Global Financial Forum organized by PBC, Wu-Tao School of Finance. I think the topic is very important. Probably it's not the most innovative topic, but it is a very important topic. And we are promoting the China to be a financial powerhouse and establish a new financial system construction in China. And against such a background, we need to consider how theoretically and practice wisely, we should establish an innovative development perspective. Now, I would like to share with you how the equity investment could support the technology innovation. And there are several parts in my presentation. What my point of view on technology innovation and what to do. First of all, we need to establish a blueprint for the innovative development. In the first 2 decades of 21st century, where China's economic development is benefiting from the dividend of the population and the financial cycle.
So these become our main battlefields for development. And in the 20th Party Congress report, we said like innovation is the most prominent factor in development. Promoting the cluster-based development of strategically emerging industries is essential, and developing new artificial intelligence and other new sectors as new drivers for our economic development. Some of the sectors have been pointed out as the key drivers and the tasks for the next period of development. And the development of new quality productive forces is also essential, and the low altitude economy and some other industries are singled out as the potential drivers and engines as well. So when it comes to the 14th five-year period, we talked about eight different industries. And if you look at last year's Financial and Economic World Conference, that's clear. The trend is very clear. Biomedicine and commercial aerospace and low-altitude economy, those are emerging as more important industries. I think it's a very important, lofty direction for us to pursue. At the same time, it has specifically pointed at some key industries? How do we leverage resources across society to support their development? And high-tech industries is becoming a more bold force to be reckoned with in the Chinese economy. And the downward trend in real estate sector is now being addressed with adaptive policies. The next priority is about how can we give more momentum to technology industry's development. Since the end of pandemic, the rebound of the tech sector has injected impetus to economic growth. And I was talking to some colleagues. Some people talk about how severe the lockdown was, which basically cut off investments, and because you couldn't really get a signature from your higher-ups, and people were really concerned about the prospects of investment because of COVID. But the strategic emerging industries actually experienced kind of swim against the current and collected more investment than ever. Statistics from MIIT saw that the Chinese sectors were resilient. High-tech sectors delivered on its performance. In 2023, high-tech investment increased by 10.3%, which is 7.3% faster than the rest of the economy. And in aerospace, aeronautics, high-end manufacturing are some of the leading sectors. And if you look at corporate operational factors, all those signs shows that industries have confidence in market development. My fund is a national level fund jointly initiated by the NDRC and another national entity. And the most recent focus is our manufacturing sector. Latest statistics show that industry upgrade is a continuous trend which stays unchanged. So for theoretical perspectives and some practical angles, we have heard a lot of different stories, be it from private sector or from the platforms. We're able to delve into those numbers and get some conclusions, be it direct or indirect investment. You have to tease out the macroeconomic trends. I think the statistical numbers show that industrial upgrade is seeing sustained momentum from renewed drivers. In the 13th and 14th five-year period, we were kind of anxious because there was no new drivers coming around to sustain economic growth. We initiated a lot of projects, but some of them did not come to fruition. And with the positive signals from the Central Party Committee and State Council, we believe we're seeing the sustainable drivers coming around or on the horizon. Strategic emerging industries are becoming important drivers and engines for the economy. At State Council, there used to be a division dedicated for technology, and then it's renamed called High Tech Division, and then it's got renamed again Innovation Capability Development, and the most recent name they have given to this division is called Strategic Emerging Industry Development. The world economy is anemic, and protectionism is raising its ugly head. So there are some profound changes in both domestic and international economic landscape with new challenges for technology development. In April, Europe launched new anti-subsidy investigations into
many Chinese companies, and then new U.S. tariffs amounted to 18 billion US dollars were adopted in recent times. And based on my initial observations, strategic emerging industries are experiencing structural changes. So from investment perspective, where we are now and where we were 5 to 10 years ago are completely different scenarios. The aggregate volume is growing continuously, both in terms of the speed and the level of growth. And the structure of that is experiencing dynamic changes. More investment is directed to new material, new energy, and AI. I know we have a lot of representatives from financial institutions a couple of years ago. Lithium battery is a very hot topic. We see a lot of injection of funds. That is why the industry of lithium battery started to become more competitive. EV battery and all the upstream, downstream projects, cathode, anode materials, and also humanoid robots, AI big models, large models. The key areas of investments are shifting and evolving at a faster and faster pace as representatives from investment fund were paying close attention to this. And I think it's going to concentrate on two things. First is to strengthen our strong link, and second is going to be strengthening the weak link. For example, we want to develop the equipment for certain industries ourselves. And the new three things means we want to develop some fusion projects that combine advanced manufacturing with digital technology. So digital technology alone, if there is no linkage to real economy or manufacturing, then there will be a lack of projects for you to implement your digital technologies. And people are gradually investing in more earlier stage projects. And second, as an investor myself, be it institutional investor or platform investors, I just heard from a lot of speakers. On the basis of the big picture, we can propose some of our own ideas. We need to develop a sound pipeline of projects to sustain future growth as an investment fund so that it will have great exits and great outcomes. The 14th five-year plan, we pointed out the importance of increasing the percentage of equity investment and more direct investment as well. We want to shift from investment-driven to an innovation-driven model. Private equity is a very important force in technology innovation. In innovation, equity innovation is playing a more important role in supporting tech startups. Smart funds and patient capital, these are the keywords that are gaining traction. I don't want to go into too much details, but I wanted to say that private equity investment, private equity, it has been playing a very important role in establishing a startup ecosystem of financing. Private equity investment fund will integrate itself into the main areas, main arena of the national economy without emerging as a more important player. Private equity funds will face development difficulties themselves. So that is why, despite pandemic restrictions, private equity's volume increased at a steady pace. and the State Council meeting, Central Economic and Financial Work Conference. There was many meetings and documents in support of this. Last year, the State Council issued a regulation for private equity investment. It has helped the private equity space become more law-based, more standardized. It's another major milestone. And then I think the other speakers touched upon all those documents and policies. One of the salient features is that there is a high degree of consistency. I don't understand this that well, the top-level design and the regulations, but I figure the next step is going to be about increasing policy transparency and policy as institutional consistency. Private equity regulation was launched after 15 years of crafting and fine-tuning. So it's going to take time for rules and stability to come along. So we have to bide our time, but I think inevitably it's going to be the next step. It's only a matter of time, and I believe it's going to accelerate. Some statistics show that by the end of June 2023, total private equity investment covers 200,000 different entities, and total investment volume was 1.2 trillion RMB. Private equity investment compared to pre-pandemic years, I don't know whether you share the same observation. I'm not that familiar with this myself, but to some degree, are all those private equity investors shifting to so-called hard technologies? I think if you ask anybody, a lot of them are very specific. Some say they invest in hard technology, they invest in new energy or semiconductor. They will just flock to what everybody's investing in. Be it a investment training session, road shows, or a panel discussion, all the topics have to do with, biomedicine, AI, LLM. This is what everybody's flocking to and clamoring to invest in. All the funds are saying they are investing in hard technologies. Everybody's investing in semiconductor chips. If they don't invest, they're going to feel ashamed. So they have a very concentrated portfolio. Everybody's investing in what we call hard technology. So the capital market reform is deepening and continuing, and private equity space are seeing improvements in its ecosystem. There are multiple challenges and impact. We're seeing some difficulties in fundraising, post-investment management, and less predictability for exits. As fund investors, we're faced with many uncertainties ourselves. One of the key principles we must keep in mind is that as an investor, let me be bold here to make this statement, be it direct or indirect investment, our approach is completely different from what it used to be before the pandemic years. The same methodology is not going to work for today's era. So through the PBCSF forum, which is a high-end platform, I hope that we'll be able to concentrate resources and pool the strength so that we can address those issues properly through smooth channels.
So the investment activities are declining. A lot of companies wouldn't like to invest even though they have money in their bank account. And some of the companies do not have sufficient money, therefore they're even more cautious when investing. And the semiconductor and electronic equipments, IT, biotechnology, medical health, machinery manufacturing, and chemical raw material and processing, these 5 sectors are still the heated area of investment. And even though the hard technology industry is still the major areas of investment, now I would like to share with you what are the risks and challenges for the PE. Firstly, it's difficult to fund. This situation will continue. And secondly, market competition will be fiercer. and with the underlying institution and system issues, as well as the supervision issues and industry incentive issues. How the products could be matched with the PE investment and equity investment and other investment vehicles. We need to further explore how to get rid of the institution system obstacles. And the underlying issues related to the institutions and the systems, including the legal framework, are the major reasons for the a lot of risks for the PE and investment institutions. And a lot of financial institutions are trying to clearing out from the market, and the Matthew effect is getting more prominent. If we still follow the old approach for investment, however big funds you have, the investment path wouldn't be very smooth as before. Third one is rebuilding of the industry chain and the supply chain. Number 4 is the high evaluation risk. These two issues have been mentioned for the past few years. Compared with the 3 to 5 years ago, the two chains of challenges today are very different from what 3 to 5 years ago even. So we need to consider the real situation. And then, especially, we need to do some researches on these supply chain and production chain related issues. And meanwhile, trying to embed the products you launched into the supply chain and product chain. And lastly, what are the challenges and opportunities for the equity investment? I believe in 2024, the PE investment will continue to face the upgrading of the industries, and the market structure continue to change. And the niche market, niche sectors would continue to switch. So we need to establish a new perspective in front of these challenges and these changes. These are the following points are just for your reference. First of all, to take an overlook and observe and estimate the overall macroeconomic environment. And whatever niche sectors you're investing, the macro level understanding of the economy is very important. And secondly, we need to understand the overall industrial investment and the trend of equity investment market, as well as the trend of supervision against the new era, how it's going to upgrade and optimize. We could have in-depth understanding and insight by analyzing the overall environment. And secondly, we need to focus on the policy changes in order to understand the direction of investment. From my personal perspective, be it the government report or the Central Financial Work Conference or Economic Conference, I think there are a few insights I would like to share with you. The first one, leading industry, is to consolidate and expand intelligence and internet-connected new energy industry. And there are 3 new drivers. First of all is biomanufacturing and commercial spaces and low-altitude economy. And number 3 is 3 new industries, as I mentioned. Lastly are 2 niche sector, which is quantum technology plus bioscience. And the future is coming soon, especially for the breakthrough of technologies. As mentioned in the government report, a new quality productivity is coming soon. And quantum technology and bioscience should be the focus of the equity investors and the PE investors. And last but not least is understand the market changes and come up with a comprehensive strategy coping with the new changes. And the PBC School of Finance is a very important platform of think tank. Together with other senior education, so we conducted some research and cooperations. Most of the projects are only for research purpose, but there might be value for future investment as well. But we need to understand how to break the obstacles caused by the institutions and systems. Thank you.